So far we have considered only single stage dividend discount model where the dividends were expected to grow at constant rate for a longer period of time. But let us assume there are more than one stage. So there is not one single growth rate for the dividend. Temporarily, the company is enjoying high growing market and the growth rate is higher for a few years in first stage, and then it will drop to a sustainable growth level. So after a future date, dividend growth will be assumed as constant. Before that, the growth will be something else. So we can estimate the dividend given by the company during rapid growth period. So we can estimate the dividend individually for those years, and then we can use Gordon growth model to estimate the terminal value of the company when dividend growth rate is constant. So once we know that terminal value, even that can be discounted to present value, and that can be added to those dividends present value, and the total present value is going to be the value of the stock. Let us look at the formula to understand it better. So this is the value of the company. Here GS is the short run growth rate. So let us see, the dividend is growing with this rate, so D naught into 1 plus GS to the power T for all those years, divide by 1 plus R to the power T. So we are discounting it to present value, and T is varying from 1 to N. For all those years we have the dividend discounted to present value. So this is the sum of dividends at present value. Then we have Vn, which is terminal value of the stock at a point after which it is going to have a constant growth, and that terminal value is discounted to present value. What is the terminal value? Vn is Dn plus 1 divided by R minus D. This is nothing but based on Gordon growth model, because after that point it is going to grow at a constant rate, which is G1. R is the required rate of return. Dn plus 1 is dividend in next year from the point from which is going to be having a constant rate, and this dividend can be calculated as D naught into 1 plus GS to the power N. This is the dividend before that period, growing at short run growth rate. Then next year's dividend is calculated by multiplying it with long run or sustainable growth rate. So this is nothing but D1 into D naught into 1 plus G. So here this G is G1, which is long run or sustainable growth rate. Let us look at one numerical example to understand this multi-stage model clearly. Suppose there is a company where the last year dividend was $5. So D naught is $5. Dividend is expected to grow at 12% for next 2 years. So this is short run growth rate 12%. This is applicable for 2 years. After 2 years, the dividend is expected to grow at constant rate of 6%. So this constant rate is 6%, which is long run or sustainable growth rate. The required rate of return R is given to be 10% or 0.1. Now we need to find the value. So the value is going to be, first we will take all the dividends. So first year dividend is going to be 5 into 1.12, which is short run growth rate, divided by 1.1. This is for first year. Now let us look at the dividend for second year. It is going to be 5 into 1 plus 1.12 square. Then it has to be discounted. So 1.1 to the power 2. So these are the two dividends. Then we have the terminal value, say Tn. This is the value at the beginning of third year. So we have to discount that also at same 10% rate. So this is at the beginning of third year or at the end of second year. So this value can be calculated based on Gordon growth model. So we can have D, which is 5.5 into 1.12 square. Then we have next year's dividend, which is going to grow at 6%. So into 1.06. This is long run or sustainable growth, 6%. Then we have to see R minus G. R is 0.1 and long run growth rate is 0.06. So this is how we calculate the TN, and then we can put that back. Let us look at the individual values. So D1 is $5 into 1.12, D2 is $5 into 1.12 square, and D3 is 5 into 1.12 square into 1.06. See, this is how we have calculated. This is D3 on top, it is D3. Okay, this is D2, this is D1. Now we need to discount them. So D1 is discounted for 1 year, D2 is discounted for 2 years, and the value V2, which is the terminal value, is discounted for 2 years. And terminal value is calculated based on D3, the dividend for third year, divided by R minus G. R is 10%, G is 6%. Based on that, we have the value of V2, which is terminal value, and that terminal value is put here, and sum of all these present values, we get 147.623, which is the total value of the security. So this is how we have two-stage model. We can have multi-stage model. On the same lines, we can discount at the cost of capital to find out the present value. Now let us compare these models. So one is Gordon growth model, where we are assuming that dividends will grow at a constant rate. Then we have two-stage model, that company will grow at high rate in the starting, in short run, and then it will stabilize to a long run or sustainable growth rate. And then we can have three-stage growth model or multi-stage growth model. So if the company is stable and dividend is being paid regularly, for those kind of companies, Gordon growth model is useful. This is also useful for valuing indexes. Two-stage model is useful for the companies where the current growth rate is very high, which is not sustainable, and it will fall to a stable rate in the future. Current rate is very high, but after a few years, it will stabilize to a lower value. And three-stage growth model will be useful where the company's initial stages will have high growth rates at different levels. Say for first 5 years, the company is going to have 12% growth rate. For next 5 years, or 5 to 10 years, it is going to have 10% growth rate. And after that, in long run, it is going to have say 8% growth rate. So this is three-stage growth model. We can also use two-stage growth model for the companies which were in constant growth phase earlier, but now they are in declining phase. They are losing market share, or they are gaining market share, or in high growth phase. So they also fulfill the condition of two-stage growth model. So that model can be employed in such firms also. So this was all about cash flow based models. Now let us look at another kind of equity valuation models. Multiples based on fundamentals and comparables. So first multiple is price multiple, where we look at the market price as a multiple of some fundamental factor. It could be book value, it could be sales, it could be earning per share, etc. The price multiple is used because it gives a comparative perspective to the analyst. So the stock's price multiple can be compared to a benchmark value based on the index or based on the industry, or we can even compare it with competitors in order to find out whether the company is underpriced or overpriced with respect to industry or with respect to the peers. The common price multiples could be price to earning, price to cash flow, price to book value, price to sales, etc. So these are easily available. They can be easily calculated as well from the income statement and balance sheet or cash flow statement. They are also used in time series analysis and cross-sectional comparison across the companies. The major drawback of price multiple is that it reflects that the past information of historical data is reliable to predict the price. So since the denominator of say price to book value, price is the current price but book value is the historical value. Similarly, price to earning per share. So this earning per share is for last year, this is current price. So this is a lagging information. So in order to address this drawback, analysts use leading values. So they estimate book value of next year, earning per share of the next year, and that is used for price to earning per share or price to book value ratio, so that this drawback is addressed. So leading values are used. Price multiples could be based on comparables, where we are comparing it with other companies, for example price to earning ratio of one company with some other peer, or it could be based on fundamentals. For example, price to book value, where we are not comparing it with other company, but we are looking at that price multiple in absolute terms. So it is not dependent on the current market prices of other companies for comparison. So these price multiples can be used for comparison purpose, like price to earning, sales, book value, cash flow, etc. They also can be industry specific. For example, if some industry is more asset intensive, then it might have lower price to book value. But if it is a service company where the value of assets is not very high, since they are very small, then price to book value is very high. So multiples are generally industry specific. For one kind of industry, we rely on one kind of multiple. Now let us move to the next concept, which is calculation of price multiples. We have already seen that we can calculate the current price or value of the stock based on Gordon growth model, which is D1 divided by R minus G. D1 is the dividend of next period. So this can give us an idea about P naught by E1. This is price to earnings ratio for the next period, where it is leading value. So we divide both sides by E1. P naught by E1 is D1 by E1 divided by R minus G. We know D1 by E1 is expected dividend payout ratio. D1 is the dividend which is expected to be paid at the end of next year, and E1 is the earnings of next year. So D1 by E1 is nothing but the payout ratio. So this model was useful where we have constant growth. This is the leading PE ratio and it is valued in the market according to the constant growth DDM, dividend discount model. So from the formula we can understand that the primary factors which are considered in this PE ratio are required rate of return, that is R, growth rate, that is G, which is assumed to be constant throughout. So they are very sensitive. Since their difference is used in the denominator, they are very sensitive and a small change in them may have large change in the stock price. From the formula itself we can understand that the PE ratio based on the fundamental will be higher if the dividend payout ratio is higher, that is D1 by E1, it was in numerator. So if this is higher, the price to earning ratio is going to be higher. If the growth rate is high, we have K minus G or R minus G. If the growth rate is high, this number is going to be low and P naught by E1 is going to be high. And let us look at the third term, which is required rate of return. If K is low, then this denominator is going to be low and P naught by E1, price to earning multiple, is going to be high. So if the company is increasing the payout ratio, this number is being increased. We know from our earlier formula, growth rate is equal to retention rate into ROE. Our growth rate is going to fall. So these two parameters are not independent of each other. If D1 by E1 dividend payout is high, then growth rate is going to be low, which is also called dividend displacement of earnings. That is, if high fraction of dividend is paid in current year, the next year's earnings are replaced. There is less possibility of higher earnings in next year. Let us take a numerical example here. A company is expected to pay out 40% of its earnings as dividend. So dividend payout ratio is 0.4. Both earnings and dividends are expected to grow at constant rate of 5%. So G, which is constant, is 5%. So we can use Gordon growth model here. And the required rate of return on the stock is 13%. So this is R, which is 0.13. So we need to calculate expected P by E ratio. Expected P by E ratio is nothing but dividend payout ratio divided by R minus G. So it is going to be 0.4 divided by R, 0.13 minus 0.05, which is growth. So it is 0.4 divided by 0.08. So it is 5. We have 5 as price to earnings ratio. Now let us move to the next slide. The multiples based on comparables. So we have the principal law of one price. If certain stock or security has one value, it is going to have the same price. So if two assets are comparable, they should have approximately the same multiple. Suppose there is company A, company B, which are similar to each other. If it is going to earn say $100 million in coming year, and companies B is going to earn $50 million in coming year, then the price of A should be simply double of price of B, or we can say price to earning ratio of A and price to earning ratio of B should be same, since they are similar. Their prices and earnings are different, but price to earning ratio should be same, since they are comparables. Based on this model, stock may appear overvalued, but based on fundamental method it could be undervalued. So both methods can give us conflicting results. Also, if both companies are using different accounting methods, that may result in different price multiples. Also, the price multiples for cyclical firms is going to be dependent on the economic conditions or stage of business cycle at that point in time. So it might change. Now let us move to next kind of multiples, which is enterprise value multiple. Enterprise value multiple is nothing but enterprise value divided by a factor, which could be EBITDA, earning before interest, tax, depreciation or amortization. And the enterprise value is the total market value of the firm. We subtract cash and short-term investments from it. So the advantages of this enterprise value multiples are when we are comparing the companies which have different capital structures. So we can use EV multiple. Another advantage here is that we are using earning before interest, tax, depreciation or amortization in the denominator, which is always a positive number. So we are going to have this ratio as positive number. While using price to earning ratio, even this number can be negative when earnings are negative, because earnings could be negative because of high interest, tax or depreciation, etc., whereas EBITDA is positive. So more likely we are going to have positive numbers in ratio. Let us take an example here. The stock price is given to be $40, shares outstanding 250,000. Market value of long-term debt is 600,000. Book value of long-term debt is $1 million. Book value of total debt and liability is 2.5 million. And the cash and marketable securities are valued at $250,000. EBITDA is also given, which is $2 million. We need to find out the enterprise value multiples. For this, first of all, we need to find out enterprise value. EBITDA is given, so we can divide enterprise value by EBITDA in order to find out the ratio. Enterprise value is the market value of equity, and we can add market value of short-term debt. Then we can subtract the cash and marketable securities. So market value of equity can be calculated. We have the share price, we have the shares outstanding. So 40 into $250,000. This is our market value of equity. The market value of short-term debt is not given. But as we know, for short-term debt, the market value and book value are not going to be different. So we can calculate the book value of short-term debt. Book value of total debt is given 2.5 million. Book value of long-term debt is given. If we take the difference, we get the book value of short-term debt. So which is going to be 2.5 million minus 1 million, which is 1.5 million. So this value is 1.5 million. Now we have cash and marketable securities. That value is given to be 250,000. So we can subtract 250,000. So the first number is 10 million plus 1.5 million minus 0.25 million. So we have $11.25 million. This is our enterprise value. If we divide by EBITDA 2 million, we get the ratio. So in order to find out the market value of short-term debt and liabilities, we just took the difference of book values of total minus book values of long-term. So we get book value of short-term, which is equal to market value of short-term debt and liability. We add that to market value of long-term debt. So we get market value of total debt, which is 2.1 million. So this market value of long-term debt also has to be added, which we have not added yet. So we need to add market value of long-term debt. So equity, market value of short-term and market value of long-term debt, that also has to be added. So total it is going to be plus 0.6 million. So that also be added in. So it will be 11.85 million. That is going to be total enterprise value. So here says the book value of short-term debt and liability can be calculated from total debt and liability minus long-term debt. So that can be assumed to be equal to market value. For short-term, market value and book value is same. So we have taken the difference of these two. So $1.5 million. This is the book value of long-term debt. Sorry, short-term debt. So if we want to calculate the market value of total debt, we can calculate for short-term and long-term. It is 2.1 million. Though it will not be used in enterprise value calculation. There we are going to have short-term debt only. Let us see here. So this is the market value of equity, $10 million. This is market value of short-term, which is 1.5 million, and then cash and marketable securities, which are subtracted. So we have $11.25 million enterprise value, and if we divide it by 2 million, which was EBITDA, we get the ratio 5.625. Now once we have calculated the ratio, we can compare it with the industry peer and competitors to understand whether the company is overvalued or undervalued or fairly priced. Now let us look at another kinds of models, which are asset-based models. These models are based on an idea that equity value is the fair value of the assets minus liability. Here the adjustments are made by the analyst so that book values are adjusted to market values. Here these asset-based values are considered as floor or minimum value. Suppose we have calculated the book value, the market value is usually higher than the book value. Now it should adopt a forward-looking approach so that the book values are expected book values. So this kind of model will be good where we are easily calculating book values for tangible assets. It is very difficult to value intangible assets. So this model is more useful for tangible assets. The problem is that we cannot use this model for companies with intangible asset. Now let us look at the advantages and disadvantages of various models. For discounted cash flow models, the advantages are these are easy to understand and to apply, and they are used by equity shareholders for comparison between two companies and to take a decision whether to invest or not. And the disadvantage of discounted cash flow model is that they are very sensitive. As we have seen, the K and G both are there in the denominator, and the share price is very sensitive to the difference of these two. Another disadvantage is that future cash flow is used as the input, which is very difficult to predict. Future cash flows are based on the estimates of growth of sales, etc., so which are not very reliable. Let us look at the advantages of price multiples based on the comparables. These are widely used. They are helping in prediction of stock returns. They are easily available. They can be calculated easily. And the multiples like enterprise value by EBITDA can be used while earnings are negative. While price to earning ratio cannot be used when the earning is negative. The disadvantages are that they are lagging price multiples. So they are reflecting past information. They cannot be compared if the company have different size, growth and product. So the companies have to be very similar to each other for this comparison to be useful. If different accounting methods have been used, then these methods will give us different price multiples. So they are reducing the comparability. And if the companies are cyclical, so these ratios are not very reliable. They keep changing. The multiples will not be very reliable. Now if you look at the price multiples based on fundamentals, the advantages are that they are widely accepted and they are based on sound valuations. But the disadvantage is that inputs are highly sensitive. The price can change by small change in the inputs. Now let us look at the advantages of asset based models. Since we are using the value of the asset, which could be book value, they provide the floor value. So minimum value of market price is certain. This is useful for the company which have tangible assets. The public companies which report their fair values, it is going to be very useful for them. The disadvantages are the market values are very different from the book value. So sometimes book value may not give any idea about the market value. And it is not effective when the company has a lot of intangible assets, since their valuation is not very easy. And if the price of the assets are changing very fast, suppose the case of hyperinflation, then valuation based on this model is very difficult. Now that has brought us to the end of the topic. Let us take a few questions.